Hello and welcome. I'm Kelly O'Byrne, this is LCG and it's time to take a look ahead at what could drive the markets this week. So after a full week of emotion with UK inflation figures, the ECB as well as Bank of Japan decisions, we are now moving to another interesting week where the focus will shift mainly to the US as well as Australia. The week will start off with preliminary PMI numbers in Japan, the Eurozone and the US, which could give a bit of a shake to the currency markets. But these PMI-related moves will certainly remain under the shadow of more important macro events. The Federal Reserve meeting will be the main highlight of the week, with the Fed expected to keep interest rates at the current levels. But it will be the accompanying statement that will be closely monitored across the globe. At her semi-annual testimony before the Congress, the Fed chair, Janet Yellen, discussed the Trump administration's inability to set fiscal reforms and the declining probability of reaching the 3% growth target. With nothing happening on the fiscal front, the Fed has less pressure to tighten the monetary conditions, and even less, given that the slowdown in US inflation, which was first thought to be temporary, now appears to be turning into a sustainable midterm trend. The activity on the US sovereign markets give no probability for a rate hike in the July meeting. The probability of a September and a November hike is as low as 10%, and the probability of a December rate hike is now down to 42%. Although the likelihood of another Fed rate hike is waning for this year, we remember that Yellen's committee believes that the 75 basis point hike since December did not have the anticipated impact on monetary conditions. Therefore, there still is a possibility of more action. More importantly, there is also room to discuss when and how to unwind the Fed's $4.47 billion balance sheet. So the Fed could hint at a start date in balance sheet normalisation. September could be the reasonable target for starting to let maturing assets expire without rolling them over. Although a gradual balance sheet normalisation should have an impact comparable to 25 basis points on rates, the message it could send to the market would be seen as hawkish and could put the US dollar in better shape. On the other hand, a lack of detail on timing and the size of the Fed's portfolio unwinding plans could further weigh on the US dollar as well as yields. The Fed's statement, along with its reaction, could leave the June preliminary durable goods orders data, due on Thursday, under the shadow. Still, analysts expect a 2.7% rise in June, following 2 consecutive months of contraction. Good data could lift traders' spirits, yet the reaction will of course depend on the post-FOMC mood. On Friday, the US will release its second quarter growth estimate. The US GDP could improve to 2.6% annualised during the second quarter from a 1.4% printed previously. Any positive surprise could revive the hope of reaching the 3% target and give a boost to the Fed hawks. In Australia, the second quarter inflation figures should help get traders' heads straight on Wednesday. As a result of gradual rise since mid-2016, the Australian price inflation reached 2.1% year-on-year in the first quarter. This was the highest level since September 2014. A further rise in consumer price inflation could revive the RBA hawks and give further support to a market already on fire due to a carry rush into Australia's high-yielding currency. On the other hand, a softer inflation read, depending on how soft it is, could cool down the upside pressures, trigger a short-term downside correction in the Australian dollar, and generate dip buying opportunities for traders who have missed the latest rally. But could the Australian dollar's positive trend be further supported by solid Chinese data and softer Japanese, European and US yields? And finally, the UK will release the second quarter advanced GDP data on Wednesday. The British economy is expected to have expanded by 0.3% last quarter, slightly better than the 0.2% printed previously. A strong read could of course give a boost to pound lovers, yet Bank of England hawks are now obliged to share the market with the doves, after the inflation in the UK eased to 2.6% in June unexpectedly. And that's your week ahead update. Please don't forget to follow LCG on our YouTube channel as well as social media to get the latest videos as they're released. Thank you for watching.